Hello and welcome to Pro Trader Strategies Market Commentary for Friday, January the 31st. My name is Eric Wilkinson and you very well may recognize me from mainstream media as the Wolfman, where I've talked about everything from economic to geopolitical and market analysis. I do about the same thing in these daily market commentaries where I talk about the economic data, how I see that impacting the overall markets, but then I layer something else on there, and that is trading options in and around those assumptions we come up with throughout the day. Also, remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, let's get on with the economic data. Sorry, I've got a scratchy throat, not feeling very well. I kind of spiraled down yesterday and not feeling 100%. So please bear with me. Let's talk about but I don't want you guys to miss out on some of this stuff. I'm still trading despite the fact that I feel cruddy. And so we move on with our lives, right? So let's talk about the economic data across the pond. We got German retail sales coming in at negative 3.3%, excuse me, and French preliminary CPI coming in at negative 0.4%. That actually was slightly better than the expected negative 0.5%. Spanish GDP coming in slightly better at 0.5%. CPI, Consumer Price Index out of Spain, came in at 1.1%. Italian preliminary GDP coming in at negative 0.3%. All in all, across the pond, these economic data points are not very good, especially that German retail sales. That caused an initial sell-off in the overall markets. We started seeing some weakness off of those data points. We also got, excuse me, European CPI flash estimates in line with expectations at 1.4%. Core flash estimates 1.1, slightly lower than the expected 1.2. We also started seeing airlines say they're going to cancel flights to China. Basically, they're 40% full already, so they can't really make money flying there or back. But what they're doing is as a service to U.S. citizens, especially I think American actually just recently came out and said that they were going to stop or cancel flights. Delta Airlines already did, and I believe United is following suit as well. That's going to hurt probably a lot of commerce, right? We're already starting to see some of this slowdown, but now if we start seeing this lockdown on people traveling, that's going to hurt even worse. Let's take a look at here in the United States. We got our core PCE price index, which is personal consumption expenditures, slightly higher than expected at 0.2%. Then we got the personal spending in line with expectations at 0.3%. Personal income lower, and they revised last month's number lower as well by 0.1%. This one came in at 0.2%, expected to be 0.3%, and they revised last month's number down from 0.5 to 0.4. Not really good. We'd like to see personal income start to increase. I'm a little bit surprised about that. I think that with full employment, we should start seeing some wage inflation here, as if you want to hire, you have to hire away from somebody, which ultimately means that you're going to probably have to pay that person more. The real wet blanket on the overall markets today really came in form of Chicago PMI, which is Personal Managers Index. Remember, that's the forward-looking one we like to look at. That came in at 42.9, expected to be 48.9. Anything above 50 is expansion. Anything below 50 is contraction. That number is like the lowest number since December of 2015. So a real low number there, and that does not bode well going forward, as the purchasing managers are not seeing demand down the road, and that signals recession. All right. We also got University of Michigan consumer sentiment coming in slightly higher than expected at 99.8, which is a bit surprising with some of the other economic data points that we've gotten, and inflation expectations 2.5%. All right, economic data out of the way, not looking too good. All of those data points really kind of signal some bearishness. Here we see crude oil coming off 51.38 right now, at down 77 cents. Near the lows of the year. You can see $50.52, so we're just slightly higher than that at this point. We are below that value area low. We're starting to see some acceleration to the downside. Again, down into the 40s, we could see it. That's really going to be a product of the markets really pushing down there and seeing bad economic data. That would, especially with Chicago PMI, right? Purchasing Managers Index. Well, if the manufacturers aren't seeing demand, they are not going to have demand for crude oil distillates that go into the process of manufacturing. So they're seeing that weakness there. So it is being reflected in crude oil. So starting to really see that slough off. Again, I talked about this. Anything below like 50-ish area, we're starting to get into that area where the frackers are going to be worrying about making money. So they might start pulling back on production. If they pull back on production, that limits supply and should support these levels at least. One thing to note, though, that these guys are seeing a glut. Even though they're refining these products, we're seeing a glut happen there over in the gasoline as well. Consumers really not buying there. Bonds moving higher today by about 21 ticks. We've talked about this. The bonds had an inverted yield curve to the shorter term interest rates. That signals recession as well going forward. The Fed talking about being data dependent, whether or not they're going to lower interest rates. I don't think that they'll lower interest rates much further than this. And the next interest rate move is expected in November. So, quite a ways away. We might start seeing that start roll a little bit closer to summer, though, as the overall economic picture starts looking a little bit bleak. All right, so bonds starting to move a little bit higher here. Gold futures, they're starting to, I don't know why I don't have gold up here. Let me try and find gold real quick. That's crude oil and gold futures. Oh, it's because it's over on the wrong side. Gold futures are starting to rally, wanting to test that 1600 and the value area high. This is a flight to safety as we're seeing the equities really start to sell off. They are going to put their money in gold, especially if we start seeing the Fed start doing more non-quantitative easing. They're going to try to spur on inflation, get those dollars out there. Well, a weaker dollar strives gold futures higher. And then we go over to the VIX. The VIX is spiking by about 2 points, trading up into the 18 handle today. Nice big move. We're starting to see volatility outside of some of even these earnings, which is a positive prospect for us to be able to take advantage of. All right, Dow Jones, you can see here off 437 points near the lows of the day, breaking below that 50-day moving average. That's pretty key, you guys. Settlement below that is going to even show further weakness going forward. I was expecting us to have this correction moving down, like I talked about with the NASDAQ moving down and testing that 8,800 level. I think it's going to take about a week or two, but with today's big move and the economic data that we've been getting not being so great, we could start to see this really roll over. One thing to note, next week we do get non-farm payrolls on Friday, so that's going to be a big number to watch because that's going to tell us what it looks like for the hiring going on. All right, so down off, NASDAQ off by about 183 points. E-mini S&P is off by about 52 points, encapsulating just about the entire week. So we are finishing on the lows of the week if we were to stop here. Again, market looking like it wants to test that 3,200 area where I've talked about where we've gotten this consolidation. 50-day moving average slightly lower, but we could easily see this market with the bearishness that we're seeing right now test this Fibonacci in the weeks coming up here at 3166. All right, without further ado, let's get on with the well, I thought I was going to go on to my trades, but we'll talk about this. This is the 30-minute chart of the mini S&Ps. As you can see overnight, when we started seeing the airlines saying they weren't going to fly anymore to China, a lot of lockdown there, and then right here, the Chicago PMI, you can see almost unabated to the downside, just full on selling mode going on right now, and we are near the lows of the day as well. So a lot of bearishness in there. Institutional trading going in and selling with both hands out. That means basically they are dumping everything, is what we used to say on the floor. But I don't think that we're going to see the consumer come in and support this market at these levels at this point. All right, let's talk about GLD. I pulled the ripcord on this trade. If you guys remember, in GLD, I had on the February and did a risk reversal where I had sold the 148 calls and bought the 139 puts in there. Excuse me. And I originally did that for 29 cents. So, sorry, I did that for, where is it on my gold trade there? I did that for 29 cents. Yes. So for gold, I had collected a credit of 29 cents on that risk reversal. I was expecting gold to come back down and test this point of control. Not with this kind of market. I don't want to stick in there. I think it could easily go up and test 1600 if we see further weakness in the equities. So I decided to pull the ripcord on that and bought it back for $2.48. So that one was a loser. But I was playing that to the downside, thinking that we were really going to see these numbers continue to be as bad as they are and that we were going to start pulling out of it. But at this point, I would even have to be remiss to not go in there and dump that. You know, the market can continue to move higher. I'm not going to play around with that anymore. All right, so out of gold futures. All right, Delta Airlines. I'm not ready to pull the ripcord on this one just yet. I'm actually looking to do some dollar cost averaging. I think that pretty much a lot of this weakness has already been priced in there. I'm going to stick with it for just a little bit longer, despite the fact it's also a great hedge with Boeing. And I'm kind of liking the way that that pairs trade is working out. So I'm going to leave it on, but I am going to continue to stay mechanical with this and try and lower my overall cost basis on this. So with DAL yesterday, if you guys remember, I had on the 60 calls in there, and I decided to cover those late in the day yesterday. Actually, not really late, but late after we did the daily market commentaries. So I had on the February, sorry, it was the February 63 calls that I had originally sold for 40 cents. I bought those back for 7. Now I am looking to try and get into this, lowering my calls, and went in and sold, or I'm working the Feb 59 calls in there and trying to collect 48 cents. So it hasn't gotten hit. We're continuing to see DAL. I started out at like 53 cents and have continuously started moving that down. I'm waiting for one just uptick in here, but it's just not happening. So I'm going to try and sell some more calls in DAL to lower my cost basis on it. I don't want to go further than these 59 calls because right there with the credits that I had gotten from the 63 calls, and if I get this credit for the 59 calls, that lowers my break even from 60 down to about 59. So I'd be happy to get out for a scratch on that trade. Then what else we got going on here? eBay. I'm looking at dollar cost averaging at this point. I'm long eBay. If you guys remember, I'm long at like 37. So I am looking to, I went in and sold some puts in there. Again, trying to stay mechanical. If I get hit on these puts, then I'm going to dollar cost average between 37 and 33. And I've also lowered some of my cost basis on that as well. But I'm in there with the February, sold the 33 puts in there for 32 cents. So if we break below this Fibonacci right here, which I believe is going to hold support, you can see over here that that 33 area is the 52-week low. They came out with better than expected earnings, so I don't really expect us to go down there and test that. But if we do, that would be a good location to buy. So why not go out there and start selling puts rather than put it in a limit order or just try and go out there and buy right now? So selling those puts, try and lower my overall cost basis. And if I get hit on the 33 puts, then I get that stock put to me and I have dollar cost average. That's how we're That's how we're talking about in these webinars, how we implement options into our portfolio to build it out, how we stay mechanical, how we continuously lower our basis to try and increase the yield in our portfolio. And this is the best way to do it with options, you guys. All right, so that's all I got for you, other than if you can't take that, take it easy.